My name is Rhys Davies. I'm a fund manager at Invesco. Today, I'm going to be talking about Invesco Bond Income Plus. It's an investment trust and how you can earn a steady level of income from the bond market. Invesco Bond Income Plus, it's an investment trust listed on the stock exchange. So if you want to purchase it, you're buying the shares on the stock exchange. The ticker is BIPS, BIPS. So I'll refer to it as BIPS going forward. The reason I'm excited to be here today is that there is a lot more yield in the bond market than we've seen for some time. So as you know, yields on bonds a few years ago were pretty low. Move forward to today. And if you're looking for income, then it's a much better place to be. The issue that you have as individual investors is really around access to the bond market. So the typical UK corporate bond minimum denomination is around £100,000 or is £100,000, which actually puts them out of reach for most individual investors. And of course, that is where a bond fund like BIPS can be very useful. So BIPS, we run it with a dividend target of 12.25 pence per annum. So the idea there is to have a target so that investors know what to expect in terms of the income. As of today's share price, I think it's more around 7% dividend yield, but that's what it equates to today. I would say that the majority of the portfolio itself actually earns more than that 7% in terms of income, but we're choosing to keep some of that back and retain and invest that within the portfolio. So I will return to this slide later. So I also manage our open-ended fund. It's a £2 billion fund called Invesco Monthly Income Plus, which some of you may be familiar with. But today I'm going to be talking about BIPS. There we go. So I'm going to divide this into three sections. So start off with a little bit about what are high income, high yielding bonds, why they're attractive right now, some of the features of them. Then I'll move on to the market, talk about a few examples of the types of investments that we have, and then finish off with a little bit more information around BIPS itself. So as I'm sure you are aware, a bond is a loan to a company or a government, and that has some important implications if you're looking for income. So it's very different to an equity, which is as you know, a share of a company. So the two key differences if you're an income investor are really about the contractual obligation that you have with a bond. So a bond pays its income via a coupon. That's a contractual obligation. If a company fails to pay that coupon, then they would be in default. And as bondholders, we have a more senior position in the capital structure. So a bond will pay its coupon through an income, whereas an equity, of course, is paying its income through a dividend. It's at the discretion of a company. And then in terms of seniority, bonds do sit higher up in the capital structure, whereas equity, which is always the most junior partner. So that seniority point matters should things go wrong with a company. So should they fail on that contractual obligation, then as bondholders, we have the right to the ability to take the keys from the shareholders in most cases. And so if you're looking for income, it's those two key points, that certainty of income and that seniority that are really important. Of course, the flip side of that is that returns are more limited to an extent, but certainly we like bonds for that reason, especially if you're looking for income. So I'll talk a little bit about credit quality. You know, it's something that we really focus on in the bond market, and you'll hear us talk about it a lot. And what do we mean by that? Well, credit quality is referring really to the credit profile of a company. So the credit risks of investing. So much like an individual would have a credit profile, for a bond, we think about that credit profile in terms of the amount of debt that they have outstanding, the size of the company, their ability to generate cash flow. So we then categorize those risks, that credit risk, according to a rating. So that's a description of the credit risks. On the left-hand side, you can see what we refer to as investment grade rating. So at the very best at the very top end of the quality spectrum. The very best quality is AAA rated bonds. They're deemed to be very, very safe, and of course they pay some of the lowest yields. Then as you move down the rating spectrum, we come to what are called high yield bonds on the right hand side. So bonds that are rated double B, single B, triple C. We call those high yield today. They used to be referred to as junk bonds many years ago. If you're trying to sell a bond fund, obviously that's not a great idea to call them that. So we stopped doing that a long time ago. But also I'd say it's actually a pretty unfair description. So there's a lot of very good quality companies that are rated as high yield. If you take a company like Ford, for example, just last year, they were still rated as high yield. Ford was downgraded from investment grade to high yield during the COVID crisis. We refer to that as a fallen angel. So they went from investment grade rating to a double B rating. And actually a double B rating means it's still a very very low chance of a default, very low likelihood of default. So it's a little unfair to call high yield bonds junk bonds. And it's an important part of the market for us as well. So high yield bonds on the right hand side will obviously pay a higher yield because there are more credit risk associated with owning them. And it's a very important part of the market for BIPs looking for that income. So around 2/3 of the portfolio will be invested in high yield and around 1/3 in investment grade as of today. And we like high yield. It's where I've spent over 20 years really focusing in on the high yield market. My background is as a credit analyst, so looking at the high yield part of the market. So I will talk a little bit about subordinated bonds. They're not as complex or as risky as the name may sound. It's an important part of the portfolios for us because they can offer this additional income, and especially versus the high yield market, we can find some quite attractive risk reward profiles there. And by that, I mean that the income that we're earning through the yield versus those credit risks looks quite attractive from subordinated bonds, especially when we compare them to investment grade, better quality investment grade, and against the broader high yield market at the better end of that, better quality end of that high yield market. So bank capital bonds on the left. What we're looking at here are the different layers of debt within a company. So when we talk about subordinated bonds, we're talking about this bottom layer that sits just above equity. So on the bank capital side, additional tier 1 bonds or CoCo bonds you may have heard of. Lloyds Bank, for example, has a CoCo bond with an 8.5% coupon. It's investment grade rated. So if you think back to that previous slide, that means it's deemed to be a lower risk of default, better credit quality profile, investment grade rated. BNP also have an additional tier 1 or a CoCo bond. That's a big French high quality bank. That bond has a coupon of 9.25% in dollars. So we can get some attractive levels of yield from these subordinated banks on the bank capital in the banking space. These subordinated bonds in the bank space, they're called CoCos. And I would point out as well that CoCos are not accessible to individual investors directly. So again, a bond fund is a nice way to be able to access those. So why are they called subordinated bonds? And should we be concerned about that description? It's really to do with the protections that you have. So there are less protections versus other debt within the capital structure for companies that have subordinated bonds. And that means that as an investor, we need to be aware of that. We need to be mindful of that. And the way that we mitigate against that is to have good diversification and to focus on credit quality as well. So if I think about the bank capital, the CoCo part of the portfolio, we've got CoCos from around 25 to 30 different European banks within the portfolio. So that diversification amongst different banks, different credit profiles. And then if I look at the insurance capital, the subordinated bonds that we own there, they're typically investment grade rated. So again, better quality in terms of the credit profile. On the right-hand side here, we've got something called corporate hybrids or hybrid capital bonds. And these are issued by companies that are not banks, not insurance companies, but your more traditional corporates. So names like Volkswagen, BT, Vodafone, EDF, they all have corporate hybrid bonds. Typically high quality, high yield, sometimes investment grade rated. And those names that I mentioned, they're all, apart from EDF, they are investment grade rated. So again, it's a nice part of the market where we can go to look for income. And it's around 20 to 30% of the portfolio, typically over the last few years. And as I say, some of those bonds will be investment grade, some of them will be high yield. So it's another way of looking at the portfolio in terms of that split between IG, high yield, or subordinated insurance being 20 to 30% of the fund. So let's look at a few examples of the types of bonds that we can own in the portfolio and do own. I mentioned Lloyd's with its 8.5% cocoa bond. Aston Martin, if we move down the credit risk spectrum, they make good cars, but what we really care about as bond investors is their ability to turn that into cash flows. Aston Martin, we understand the credit risks of the company. We like the cars, of course, but actually they've got quite a lot to do in terms of capital expenditure, and their free cash flow for the next few years is likely to be very low or even negative. So there are some elevated credit risks there, if you like, and that's why these Aston Martin bonds were issued with a coupon of almost 10.4%. So over 10% was required from Aston Martin for bond investors to get involved with that bond. So there are some credit risks with a name like that, and the way that we would approach that is, of course, understanding those credit risks using our credit analysts, but also keeping that position relatively small, so it'd be about 0.5% of the portfolio. And then the idea is that we repeat that process over and over again to build out a portfolio of bonds that are doing what we need them to do in terms of the income that we can generate. Other examples here would be Center Parcs. They issued a bond last year with a coupon of almost 8%. If you've ever stayed at a Center Parcs and spent a small fortune there, it's quite nice to be earning some income back from that company. Heathrow have a double B rated, so again, pretty good in terms of the credit quality and within high yield, double B rated bond with a coupon of close to 6.6%. And then Legal and General would be an example of a subordinated insurance bond that is investment grade rated, and the coupon is a little lower because it would reflect that, so it's around 5.6%. So lots and lots of different types of companies within the portfolio, and like I say, building up a portfolio to achieve what we need it to do in terms of income. So I'll talk a little bit about the bond market today, and this is the yield on the European High Yield Index. And you can see over the past decade, we haven't had yields as high as this for a long time. If you put that spike in yields during the COVID crisis to one side, it's been some time since we've seen yields back up at these levels. Of course, in 2022, that all changed. The low yield environment that we had previously all changed. Inflation was a lot higher than most people had expected. That caused this very rapid and large repricing in bond markets. Yields were a lot higher. We started that year with yields in this market at around 3.4%. Not particularly exciting if you're an income investor. And today we're looking at closer to or over 6%. And we ended that year, you can see, with them getting close to 9% on a yield basis. So we've seen this big shift in yields within the bond market. And if you're an income investor, it's much more interesting time to be involved, we think. So what I'm going to do over the next few slides is kind of bring to life the market a little bit more through some examples of bonds that we own or have owned in the portfolio. This is BT. So we'll start off with BT in the UK, a big blue chip issuer, investment grade rated company. This is an example of a subordinated bond, which I spoke about a moment ago. So when BT came to the market in 2023, inflation was a little bit stickier. The market just needed a little more convincing to part money to lend to BT in terms of the coupon that we were willing to accept. And so they issued with this coupon of 8.375%, so almost 8.4% from a double B rated bond from BT. For BIPs, very happy to put that into the portfolio. It's high yield, but it's at the very high end in terms of quality of the high yield market, given that rating. And this is a price chart. So you can see not only have we had that 8.4% coupon for the last couple of years, but we've made over 7% or close to 7% in price appreciation during that time as well. Moving a little riskier in terms of credit quality. This is Ineos Quattro. Ineos Quattro is a chemical company. It's part of the Ineos stable of businesses. We've known in the high yield market Ineos for over 2 decades. They've been a borrower. We've watched the company grow into the huge company that it is today. We know the management team relatively well. Most people now are more familiar with Ineos as a name because of their sporting tie-ups, and of course, last year the owner Jim Ratcliffe acquired a stake in Manchester United. So this is a cyclical chemical commodity chemical business. So it has volatile earnings. In my previous role as a credit analyst, I've spent enough time looking at chemical companies. I've been around long enough to know just how volatile earnings can be. So our approach with a name like Ineos Quattro is to really think about and get our credit analysts to really think about the credit profile of the company, the balance sheet. Is this balance sheet built to survive a cycle in the market, in their market? And what do we think of the management team? And actually, with this management team, we know that they have a lot of experience of managing through chemical cycles, and so we were very happy to be lending to them at a pretty attractive coupon of over 9%, or close to 9.7%. What's interesting here with Ineos Quattro is the last time they issued a similar bond in 2021, and if you go back to that chart of yields and recall that yields were pretty low back in 2021, the last or a similar bond that they issued then was with a coupon of 3.375%. So big shift in terms of the borrowing costs for this company, the same as for all companies, governments, individuals. We're all in this higher borrowing cost environment, and this higher coupon that they had to pay is reflective of that. And again, it makes it a more interesting time, much more exciting time to be using the bond market to get a decent level of income. Oh, really? Okay. So this is Newcastle Building Society, a really interesting example of a bond to have within the BIPS portfolio, because it is it's a bond that you may not find in a larger open-ended fund. Newcastle is the 8th largest building society in the UK. This bond itself was pretty small in bond terms. It's about £20 million when it was issued. It's likely to trade less, be less liquid, so not necessarily appropriate for an open-ended fund, but for an investment trust vehicle, it's an ideal type of investment to have. It came with that big coupon, that 12.25%, because it is from it's a smaller bond deal. A larger bond issue from a similar company would have come with a much lower coupon. And actually, it's done very well in terms of price over that time period. So we've earned the coupon and we've earned 17.5 points of price appreciation. We do have other bonds like that within the BIPS portfolio. Being a closed-ended vehicle as an investment trust, it is very suited to owning these relatively small types of bonds from companies like Newcastle Building Society and a few other banks like that. So again, it's that point about building the portfolio up with bonds from different areas, different companies, but also thinking about buying bonds that maybe aren't going to be in other funds that are open-ended. Of course, we also trade in the secondary market, so we're always buying and selling bonds. Here is an example of a bond that we purchased in 2022 from Asda. So think back to 21 when this bond was issued. I think it was 21. Yields were relatively low. It came with a coupon of 4.5%. At the time, we didn't feel that was enough return, enough yield for the credit risks of investing in Asda, and so we didn't buy those bonds. We went through that repricing in yields in 2022, and then towards the end of the year, we had, of course, in the UK, the mini budget fiasco, and that for us gave us an ideal opportunity to start really building a position in Asda. So our average purchase price was in the just under 78. Then we start to put together a return profile, thinking about what this bond will do between then and maturity. So long as Asda was going to pay us that coupon of 4.5% per annum for the next 3.5 years, so long as they would be able to repay the bond at 100, so all bonds are issued at a price of 100 and redeem at a price of 100, or mature at a price of 100. So long as they could do that, then the return profile comes out down here on our original investment of close to 50%. So it actually stacks up very well against an equity investment. And you can see that played out very nicely ahead of time, and we were able to sell out of this position over last year.
So I think we've pretty much come to the end of our allotted time. I don't know if you've got a sort of quick summary, and then we can take some questions.
Yes. So I was going to return to this slide and just mention again this point about diversification. So very important for BIPs, very important for a bond fund to have that diversification. So close to 150 different issuers that we own within the portfolio. And then the other important point is around borrowing. So BIPs is an investment trust. It's a closed-ended vehicle. Investment trusts can borrow, and I think they should borrow in a prudent, careful way to take advantage of that. So for us, we buy more of the better quality, maybe lower yielding bonds using that borrowing to just help with the income in the portfolio. We've got a long track record, so around 2 decades of managing investment trusts with borrowing in them. It's currently at 12.5%, and we think that's a very useful tool.